Okay, so you know that data that nobody looks at, they scroll past it, they don't read it, they don't pay any mind to it. Well, it just reported something important that it doesn't line up. It absolutely doesn't match. And usually, what that means for markets is that somewhere down the road, we're going to hit this inflection point. Today, jobless claims just dropped to their lowest level in 3 years. Then at the same time, Challenger says companies have announced over 1.17 million layoffs this year alone. That's the most since 2020. Revelio Labs says the US has lost jobs 2 months in a row. And then Japan, they're like, surprise! And push their 10-year bond yield to the highest level since back in 2007, shaking everything globally up again. So let's walk through all of the signals one by one. We'll talk jobs, layoffs, real time labor data, Japan, how stocks reacted, and what big reports coming out tomorrow that everybody, including the Fed's, going to be watching. So let's start off with jobless claims. The fastest, cleanest weekly look into how the labor market's holding up. How healthy is it? And what we just got for initial claims is 191,000 for the week ending November 29th. That's down from the 218 from the prior month. That's the lowest since September 2022. Economists were looking for 220,000. So it wasn't just good, it crushed expectations. The 4 week moving average that fell to about 214,750. So this isn't just a 1 day fluke on the headline. Then you look on the continuing claim side of things, the people who are collecting unemployment benefits, collecting unemployment. 1.94 million people are on benefits, basically flat to slightly down from the week prior. The insured unemployment rate that came in at 1.3%. So by historical standards, that's very low. But there are a couple things we just got to say out loud here. So you and I are on the same page. Think about holiday distortion. A lot of people's probably not talking about this, but this is Thanksgiving week we're talking about. Seasonal adjustments always get pretty weird around these big holidays. The unadjusted claims fell by about 20% week over week. Now, on the opposite end, the seasonal model only expected a drop of 8 to 9%. So some of that big move is just math and not pure macro. Then the second thing, just because we don't see a spike in claims doesn't mean that there's not some problem out there somewhere. This is because claims, they usually spike after hiring slows or after corporate plans change. Now, they're fantastic at flagging full blown recession, but they're late at picking up a slow grind, which is the environment we're in. Continuing claims are creeping higher. So even though they've edged down this week, the broad trend that we've seen over the last year or so, it's been up. And what that basically means is people who lose jobs are staying unemployed longer than they have back in 2021, 2022. So these people are losing their jobs, they can't find new jobs, so then they have to collect benefits. But I mean, overall, the message here is that we're not in this 2008 style collapse, but the labor market, it is drifting from this red hot to lukewarm. But on its own, this report, these numbers, they say relief. But then when you compare it to this corporate data, the picture gets a little bit more lopsided and uncomfortable to look at. Now let's look at Challenger Gray and Christmas layoff report. This is where we see what companies plan to do next. This is for November. So for November, 71,321 job cuts were announced. That's down 53% from October's spike of 153,000. So yeah, that sounds good, right? That's better than last month's scare. But wait, there's more. It's up 24% from the same month last year. So just from last November, it's up 24%. Dang near a quarter. And for context, layoffs in November have only hit 70,000 or above twice. And the two times were 2022 in 2025. So pretty much right now. Now, year to date, companies have announced 1.17 million cuts. That's 54% more than the 761,000 over the same period last year. That's the highest January through November total since 2020, and only the sixth time since 1993 that these cuts through November actually topped over 1.1 million. So yeah, October, it was this big scare number, but even after that improvement we've seen, we're still sitting at historically elevated layoff territory. Now, the cuts that we're seeing, it mainly came from government. This is a huge chunk of it. We've seen 308,000 cuts. Huge chunk, like I said, this is all thanks to Doge, the government of Department of Government Efficiency and downstream impacts on contractors and nonprofits. Technology, 153.5 thousand cuts. Still private sector leader here. Warehousing over 92,000. Retail, 92,000. That's up 139% from last year. Services, 69,000. That's up 64%. And then when you look at some of the sector standouts for November, what you end up finding is that telecommunication, 15,139 cuts, biggest month since April 2020, mostly in Verizon. Huh, interesting. And then tech, this one, another 12,337, 77. Food, 6,708, mainly, especially beef services, 5,509. Retail, 3,290. So again, we're in this holiday season and we're trimming where this is really important for a lot of these companies because a lot of earnings come out of this Q4 holiday season. And the reasons that companies are giving for this is restructuring, 20,000 in November, 128,000 this year. Another one, store unit departure closures. So just closing up shop, 17,000 in November, 178,000 this year. Another one, market and economic conditions, 15.8 thousand in November, 245,000 this year. Hey, I bet you could guess this one. Tariffs, 7,900 cuts this year. Artificial intelligence, 6,280 cuts in November. 54,694 this year. More than 71,000 since 2023. And then the big one we just mentioned, Doge, the Doge impact. Government efficiency cuts almost 294,000 directly, and then add in another 21,000 for downstream. So for hiring plans, this is through November. Companies have announced 497,000 planned hires. So what we're seeing is that's down 35% from just last year. It's the lowest January through November hiring total since back in 2010. For seasonal hiring, it's telling even more. Only 372,500 planned holiday hires, the lowest since Challenger started tracking seasonal patterns back in 2012. And then in November, no new seasonal plans announced. So while jobless claims say, whoa, 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 just relax. Nobody's filing for benefits. It's just fine out there. You got Challenger out here saying layoff plans are elevated, hiring plans are weak, and companies are blaming tariffs and AI and government cuts and softer demand. So, definitely not a crash story. That's a slow pressure story. Now, let's get into the next piece. This is going to be Revelio Labs, and I'll put this on screen for us. So, for Revelio Labs data, this is like the security footage data, if you will, behind the BLS and the ADP headlines. And Revelio tracks online professional profiles, job postings, warn notices of mass layoffs, and this real time hiring attrition. So their November read, they kind of separate out their reports. I just happen to only be on the employment report. The U.S. economy lost about 9,000 jobs in November. That matches October's 9,000. So two negative months in a row. Losses were mainly concentrated in retail trade and manufacturing. For job postings, those were down about 0.3% month over month. Big deal. But biggest declines were in leisure and hospitality, which were 2.2%. Construction was offset with postings up about 2.2%. Then on the hiring and attrition part, the annualized hiring rate is around 21.5%. During 2021 and 2022's boom, that was consistently above 30%. Attrition is also failing. Fewer people are quitting, fewer poaching opportunities. And that combo leads to fewer openings, slower hiring, less quitting. It's textbook cooling labor market behavior. And companies aren't aggressively adding headcount. Workers are more cautious about leaving jobs. And overall, the churn that signals a hot economy, it's fading. But then on pay, salaries and new job postings ticked up about 0.9% versus September. Increases led by mining and transportation, warehousing, wages in health and education, utilities, and leisure and hospitality actually ended up falling, and then layoffs via Warn. November Warn notices and actual layoffs linked to earlier notices decline. So mass layoff events, they've cooled a little bit, but even while overall employment is showing slip. So you put all this together and you got jobless claims. There's no stress. Everything's fine. Challenger layoffs and uh, weak hiring plans are stacking up. Revelio, the total number of people employed, is quietly inching down, and the job market is less dynamic. And that's a very specific macro vibe. It's not a recession. Again, y'all, not a recession right now, but late cycle slowing and vulnerable if anything else goes wrong. And something is going wrong, just not here right now. It's happening abroad, and this is in Japan. So Japan decided to, spice things up again, just, switch up a little bit. So today, the Japanese 10-year government bond yield closed at 1.94%, the highest since back in July 2007. Yields across most maturities moved up. The one exception was the 30-year, which cooled a bit after a strong auction. This follows, and we talked about this, the Bank of Japan governor hinting at this December rate hike and how it's very much a live option that they could go with. And today he's added that there's some uncertainty about what their neutral rate is, which speaks for we're not sure how high rates ultimately have to go. Now, why does this matter so much? Well, we talked about this before, but if you haven't tuned in, Japan has been this cheap money machine for the entire world. They have ultra low or even negative interest rates in history, massive quantitative easing, and the foundation of the classic yen carry trade. So, pretty much, you borrow in yen at these near zero rates, convert it to dollars or euros or something else, then simply you buy other yielding assets that are yielding much higher, like US treasuries or credit or even stocks or even crypto. And then you just pocket the spread and hope that the yen doesn't spike well, like we're seeing. And when Japanese yields move from basically zero to back almost 2% on the 10-year yield, that spread shrinks and the yen tends to strengthen. And all of those leverage positions funded in yen end up getting more risky. And people don't like risk. So that's why people worry that rising Japanese yields, it'll kind of like a vacuum suck money out of the system because it'll pull money back into these Japanese government bonds. People pay off their loans. It pushes US treasuries higher as these Japanese investors rotate home, tighten global financial conditions at exactly the moment the US labor market is slowing down. Now, like I keep saying, it's not a recession. It's not full blown contagion yet. US yields only nudged up higher today, closer to 4% for that 10-year treasury. But this is the second time in just a few days that the Japanese bonds have sent this ripple through the global markets and kind of like getting people off of the edge of their seats to see it. Now combine that with the US workforce that's softening under the surface, and you got this kind of backdrop where one policy mistake can matter way, way, way more than usual. So, with all of this, how do you think markets reacted? Well, they did so by basically struggling. So, on screen today, we got the NASDAQ. Well, yeah, we got the NASDAQ on screen. And this one, it increased. A lot of movement around. closed up 0.22%. For the S&P 500, it's up only about 0.11%. For the Dow, it was actually down today 0.07%. Bitcoin down 0.8%. This one keeps on juggling around. But the market's been making moves all over the place, but it's pretty much like, eh. And yet, if you look past today's tiny candles, Wall Street's big houses are almost, well, pretty upbeat on 2026. We got Duche Bank seeing the S&P 500. Let's put it back on the screen while we're talking about it. The SPX hitting 8,000. We're at 6,800 right now. HSBC, they're seeing it hit 7,500 by the end of 2026. JP Morgan, 7,500. Uh, Hopefully I said 7,500, not 75,000. So we're in this 3-year bull run, if you will, likely closing 2025 with another double-digit gain. And the official sell side story is basically, yeah, let's just keep going, but there's plenty of reasons to question that optimism. We got the IMF only expecting about 1.5% growth for developed economies in 2026. Not exactly booming territory, if you will. Inflation seems stuck around 3%, better than 8%, but it's sure well above the Fed's 2% target. And that caps how aggressive rate cuts can actually be. Then the US and China relationship is deteriorating, which that's pretty bad news for supply chains and capex planning. Valuations are stretched. The S&P 500's PE is around 30 times, and that's historically rich. The market's insanely concentrated in just a few of these AI winners. So all of this is great if it keeps delivering and continuing upward like it has, but it's brutal if literally anything breaks. And we've walked all through all of it. Layoffs elevated, hiring plans weak, real time employment negative. AI is showing up as a direct layoff reason. And AI is just going to get better. Over 54,000 jobs this year. So the weird combo we got is this price action looks totally calm. Strategist notes that sounds super bullish. If you're reading any of these articles, they see that as good. Like, all right, markets start selling off. Like, all right, looking good. And then macro under the hood that's flashing slowdown in multiple places at once, despite how the market's moving, which brings us up to the next catalyst that is coming tomorrow. And now, what everybody's going to be watching tomorrow, I needed a breath for this one because, man, this is it. We're finally getting PCE, the PCE inflation report. This is the Fed's preferred inflation gauge. And this is the first time that we're seeing this since late September. This will be September's release. And the last print we saw was headline PCE up 2.7%. This is for core. And since then, because of the shutdown, investors have been kind of a little iffy on everything, filling in the gaps with CPI and PPI and some of these other anecdotes and vibes, frankly. Consensus for Friday is around this 2.8% year over year number. That's still above the Fed's 2% goal, but markets are thinking, well, okay, if tariffs are definitely pushing some of the prices up, the labor market's cooling. If inflation is the high twos and drifts lower ish, the Fed can cut to ensure against a harder landing. They don't want to see the labor market completely fall apart. So maybe the Fed will forget about inflation for now and kind of just sweep that under the rug and help out the labor market by providing insurance cuts. And what futures markets are betting, and we can look at this together right now, CME Fed Watch tool, scroll down, 87% of a expected cut come December 10th. So if PCE it comes in cooler than expected, like way cooler, this probability to likely ease closer to say even 100%. We'll start pricing in a January 28th cut, which is it looks like 64% chance of staying steady next wait, let's look at this. So 375 through 4, and we're expecting 87% chance of a cut next what's that, next week, I think. And right now it's widely expected that they're going to cut and just stay the same, 64.1%. So if PCE comes in cool we could start seeing us pricing in more of a chance of a cut come in December. I mean, January. And yields will likely fall. Stocks could possibly leg higher if they ignore the reason why the Fed's possibly cutting. Like, I don't know. What are they trying to say? What do they see out there? But if PCE comes in higher, like these cuts will drop. The cut odds will drop. Rates will pop. And suddenly that everything's fine narrative, and especially heading into 2026, it'll have to be rewritten with a higher for longer assumption. So Friday, I mean, man, Friday is about to be one inflation number and more about whether the Fed feels like it can cover to keep leaning towards an insurance cuts or maybe not. So that's what we got today, y'all. Zooming out, jobless claims are telling one story. Then we're okay for now. And then you look at Challenger and Revelio, they're telling this other trend that we're seeing softening and hiring power fading, and we're closer to the edge than the headlines like to admit. Then Japan wants to rug pull everybody, adding global rate pressure right when we prefer things to calm down. Stocks are acting like everything's going to magically resolve itself, and AI boosted soft landing is just going to, that's the play. So, I mean, could that happen? Yeah, sure. But the gap between cheerful forecasts and messy data is definitely just getting wider, just like that K shaped economy. But I mean, despite whatever happens, rate cut, no rate cut, soft landing, bumpy landing, pull out, crash the airplane, I'll keep breaking down the labor data, the global move, just like Japan, and what it all means going forward, what the economy is doing. So hopefully this gave you a little sense of what all is going on today. Tells you what to look out for tomorrow. It's that PCE report, gonna be a big one. I'll be back to report. Y'all have a good one, and I'll see you tomorrow.